the stock rallied about 55%.
The reason our excitement about this company has increased is simply because it is now opening up to a far bigger market.
If we look at their profits, they haven't been doing well.
Its execution capabilities in one part of the business are testimony to the fact that they'll be able to probably replicate the same in the second one as well.
You have seen the markets from the pre-liberalization days to today, where the environment is very, very different.
It was just post-liberalization, and we've been going through a tough time in the economy. This I'm talking about circa 94, 95.
You worked with some great investors yourself. In fact, I believe you started your career with Mr. Raamdeo Agrawal.
I think India itself was awakening to investments, and we didn't really have as many research outfits at that point in time. And Motilal Oswal and Mr. Agrawal was spearheading that. So it was nice to be part of that initial journey.
I'd love to, get a snippet of what those days were like.
As a team, we also hit upon some very interesting investment ideas at that point in time. I'm talking about companies like Hero Honda, Hero Motors today, HDFC Bank. I remember Cipla and a few other companies, which were those strong multi-year compounders. The kind of investment returns which followed as a result of it brought this whole awakening to the fact that what a good business can do.
When we look at 2025, we have to talk about gold and silver. What were the triggers according to you? And do you see any events in the near-term future which may stop the rally that gold and silver have been seeing?
So I think we've probably reached a stage where things will stabilize. I think larger part of the monster move of gold and silver, to my mind, is probably done in the recent past. To me, it looks like probably over the next year or so, because of the prevailing conditions.
When you talk about global investment pedigree, Invesco is a name that's hard to miss. It's based in Atlanta, and it has been managing over $1.6 trillion worth of assets globally. In India, Invesco has been around for nearly 2 decades and has a host of offerings across multiple asset classes. Currently, they are managing over 1,36,881 crores as its average asset base. Now, Invesco is a fund house that is known as the Thinking Investors Fund House, and they are known for their global insights and local expertise. At the helm of Invesco is Taher Badshah. He is the CIO Equities at Invesco, and he's someone who has seen the Indian markets from their pre-liberalization days to now today's tech-fueled environment. Today, we will find out from him his views on valuations, on the market boom, and the boom in the AMC space as well. Much to talk about, so let's get started. Welcome to Groww, Taher. I can see that the festivities are continuing. You're already prepping for 2026.
Yeah, thank you very much for having me, Radhika, on Grow. And yes, I think Invesco is in the mode of festivities currently, and we've had a great time over the last 2-3 years. So it's a nice occasion to be chatting with you.
Thank you again for joining us. My first question has to be with the year that has gone by. It's almost about to close now. So, to your mind, what are the 2 highlights, good or bad, for retail investors in India in 2025?
Well, I think the highlight has been the fact that, there have been, despite, the headlines not having been very comfortable for India and the Indian economy and maybe the overall market as well. I think there has been a decent amount of returns which have been delivered across many of the funds. Many of the funds have been able to outperform in a market where headline indices have actually not done well. So I think it has, at one level, to some extent, once again demolished that myth that active fund managers have not been able to outperform over the last many years. I think that probably has been, refuted by fund managers in the current year, and they've eked out returns in a somewhat not so conducive market. That, I think, to my mind, is a reasonably good, differentiation as far as 2025 is concerned. I think the second thing as a highlight which probably stands out is that investors have been resilient despite the fact that it has been a slow year. Again, that has been contrary to most people's expectations that retail investors would probably wilt over a period of time, and especially if they probably do not see good returns. I think we've seen probably about nearly 12 months now, a little more than that, where investors have by and large gone with not so great returns. Of course, in certain areas, we have been able to outperform, like as I said, and we've been able to deliver. But from a headline perspective, it has been a soft year. And yet, money has actually kind of, been flowing in quite well, especially in the domestic circle. And I think that once again is a testimony of the fact that, retail investors over a period of time are maturing. They are seeing not just the next 1 year or the next 2 years. They're probably seeing the longer term potential of India, and they're positioning themselves for that.
So we'll talk about a lot of the things that you've mentioned, but when we look at 2025, we have to talk about gold and silver. The way these metals have shot up, what were the triggers you think? I mean, this has been spoken about, but what were the triggers according to you? And do you see any events in the near term future which may stop the rally that gold and silver have been seeing?
So, gold and silver, of course, have been the highlight outside of the equity investment world in the last maybe more than 2 or 3 odd years. I think we've seen a very strong rally in gold and silver. Of course, off late in the last 12 months, it has been an extremely strong rally. But I think this has been a slow build up in the last 2 3 years. The primary driver of gold and silver, to my mind, as we all know, has been the fact that since let's say the Russia-Ukraine conflict started post COVID, there were various degrees of uncertainties which started to build up in the market, primarily with regard to geopolitics as well as geoeconomics as well, because we had tariff-related discussions in the first presidency of Trump as well, and that already had started to have its effects post-COVID. And then there was the superimposition of the whole geopolitical problem, which came with Russia-Ukraine at one point in time, immediately followed by the Israel-Hamas conflict as well, which came about in 2023. So I think that started to galvanize gold at one level. Alongside which, what was also happening was the steady debasing of the dollar, which had also started to kind of gain currency. And that started a new wave, particularly with central banks around the world. Many of the large central banks, particularly the likes of China, Japan, Russia, Saudi Arabia, many of these countries who had reasonably large dollar assets or treasury investments or trade engagements with the United States, felt the need to start diversifying the reserves away from the dollar into some of the other currencies, other assets. And what better asset other than gold and silver as a substitute? Gold and silver and the reserves of many of these countries used to be probably about 10 odd percent 3 or 4 years back. And obviously, to that extent, it was at another extreme and needed to be a little more balanced than at being at 10%. In the last 2 3 years, therefore, the central banks have been on a very strong buying spree as far as gold is concerned. And so much so that probably almost 1/3 of the incremental gold demand in the market was being met by central banks. And central banks, to that extent, over the last 2 years have moved that 10% or to more like 35 odd percent. So that's a huge swing. I mean, if you talk about reserves of countries like China, Saudi Arabia, Japan, and so on and so forth, and 20% of their reserves actually moving into gold over a period of time, over a very short 2 or 3 year period, you can imagine in a limited supply commodity like gold, which probably grows about 6 7 odd percent every year, it can have a very strong influence on prices. So at one level, gold, to be very honest, has behaved like a commodity. It's a typical commodity where supply suddenly be limited and you have a large buyer in the room. And that elephant in the room has actually driven prices. From where we are today, to me, it looks like we've reached a reasonably optimal level. I mean, reserves can always further diversify. You can say that maybe why not be 50% and can go to even higher levels of the overall reserves. But then it becomes a little too unmanageable on the other side of the equation. You are probably imbalanced at 10%, but at 50 or 60 odd percent, you will probably become imbalanced on the other side. And gold or silver are not exactly tradable or liquid assets beyond a particular point in time. So I think we've probably reached a stage where things will stabilize. I think a larger part of the monster move of gold and silver, to my mind, is probably done in the recent past. to me, it looks like probably over the next year or so, because of the prevailing conditions with regard to geopolitics, geoeconomics, the fact that you want to generally there are a lot of uncertainties and complexities around the world. Gold and silver may still, be able to outperform, perhaps even give double-digit returns. But for investors who are thinking, looking at hindsight and seeing that, gold has done 30, 40 odd percent in the last 1 year, maybe even more, and we will probably be able to replicate the same returns in the next 12 or 15 odd months. I think that may not be a good starting point. So I think we need to temper expectations. But in the current environment, can they still probably deliver double-digit returns? I think that's quite possible.
I want to follow up by asking, did the rally in silver surprise you? Because, gold, one sees the levels going up every time there is volatility. Silver, not so much until this year.
Well, typically they have a lead lag effect. So maybe on a 12-month basis, they do not kind of correlate very strongly with each other. But over a period of time, they do catch up. Silver, therefore, to that extent, had not done as much as gold even in 2024. Okay, but it has started to catch up, and generally that follows as part of the cycle. I can understand where you're coming from, but we have to understand that silver also has a little bit of that industrial demand element, which gold doesn't have. And at some point in time, if you start to see that economies are holding up well, which is what is the case right now with the US, to some extent, there is a certain amount of improvement which is coming about in China as well. It looks like there is an expectation that industrial demand will also probably pick up. So I think that's giving a little more of that boost and momentum to silver. As a result of which, actually, if you go to see over the last 12 months, if I was looking at the latest numbers, gold has done exactly as much as silver. So the lead lags are there, but over a period of time, they catch up. The ratio does swing from one extreme to another. And maybe at some level, from an investment standpoint, it does provide opportunities as well, because usually they are reasonably correlated. And if you find that the correlation has broken down or it's gone to another extreme, then it opens up investment opportunities in one way or the other.
Okay. Let's talk specifically about a company that you've been very bullish on, to the extent that exposure to this particular stock has been increased across several of your funds. I'm talking about Zomato or Zomato. Take
Eternal
your pick. Eternal now, exactly. I think I'm glad that they moved it to Eternal, because the Zomato debate now
Created a lot of chaos.
ends. Yes. So, the stock rallied about 55% till about, if you look at the past 6 months, and I'm talking till mid-October. You've been bullish on this. Like I said, exposure in Eternal has been increased. But if we look at their profits, they haven't been doing well, right? Despite having decent revenue. So what was your thinking behind increasing your exposure, even though the profits have been on a decline?
So Radhika, Zomato, or rather Eternal now, is basically, these are platform-oriented companies. Okay, they're internet-based platform-oriented companies, and platform-oriented companies at one level or internet-oriented companies at one level is basically about first trying to understand as to what is the kind of total addressable market that they can probably cater to over a period of time. And alongside which, of course, the industry structure also matters, that how competitive is the industry? Is it a limited player market, or is it something which is significantly competitive? And in the case of Eternal, for that matter, obviously, as we know, they started off with the food delivery business. So when you have such kind of companies, which are basically platforms, but the TAM decides as to how profitable those companies can get over a period of time. And I think in case of, when it was food delivery, and the food delivery business in India probably has been around for the last maybe 10 odd years or a little less, so maybe thereabouts. There was a certain addressable market which was available for itself. Even that segment saw competition in the first instance, but then over a period of time, that competition just reduced to a two-player market. And over a period of time, that profitability for the food delivery business started to come about. Incrementally, in the case of Eternal, while that food delivery business went through its own pangs of developing scale over a period of time, and then alongside scale came profitability, we basically started to see the new beachheads, particularly as far as quick commerce, start to get established, or let's say the last 3-4 years. Now, this was an addressable market which is probably many times bigger than that of the food delivery market, because food delivery beyond a particular point is just serving a certain need, right? Whereas quick commerce at this stage, in our own experiences, in our own daily lives, um, we know that when food delivery started off, let's say a couple of years ago, we used to essentially look at buying small ticket items before we got into that experience. Maybe things like toothbrushes, lipsticks, and smaller kind of items, low ticket items. But over a period of time, what has happened is that the platform has now started to develop uh, use cases beyond these small ticket items, and it's moved to people even buying mobile phones and television sets and jewelry
Change in
and so on
consumer
and so.
behavior.
So consumer behavior has changed rapidly, and you are able to use and extract that platform for multiple use cases compared to what probably was thought of as earlier.
Yeah.
So what has happened in case of Eternal is that a new market has actually come about, and then market fortunately happens to be multiple times bigger than the food delivery market. Because if you think of quick commerce, you can think of almost every possible item under the sky which can actually be bought by people like us on an online platform, right?
Yeah.
So I think the TAM therefore, multiplies manyfold, and alongside which, just like in case of food delivery, even quick commerce is probably going through its own competitive, churn. It is still at a stage where, because the market is large and because it is growing at a very fast rate, it is still having, maybe a more than the desired number of competitors at this stage, let's say. But over a period of time, even this business will be about scale. It will be about having a back end sorted, which is different compared to, let's say, food delivery. Food delivery has got nothing to do with the back end beyond a particular point. But here, the importance of your network, your dark stores, and your positioning of the dark stores is very important. It's more like a land grab in terms of where your dark stores are positioned versus that of the competition. So I think in all those things, we see some companies having a higher advantage, maybe first mover advantage. Probably they are growing at a faster rate. The fact that probably they've proven themselves in terms of execution discipline as far as food delivery is concerned, which makes probably investors believe that even in the quick commerce business, they will be able to kind of deliver on that same scale and promise. So I think that's the reason our excitement about this company has increased, is simply because it is now opening up to a far bigger market than we had originally as part of its investment argument. And the second thing is that its execution capabilities in one part of the business are testimony to the fact that they'll be able to probably replicate the same in the second one as well, which is a far larger opportunity. And over a period of time, we believe that they will be, if not the top player, they will be one of the top 2 or 3 players in that particular space. So I think that's what has basically, despite the fact that, like as you said, numbers near term do not probably illustrate that. Maybe still profitability is a little behind. Multiples therefore look
More
significantly
than halved,
elevated.
actually.
But even there too, I think on the profitability front as well, I would say that they've done a reasonably decent job. Food delivery also, their profitability targets have been achieved faster. I think even in quick commerce, the profitability is on a quarter by quarter basis. The losses are reducing, and they are much lesser than our own initial expectations, and that perhaps even of the market as well. So that is basically where the story lies. That you have to look at the delta and the fact that this is still a very, very large market.
And I think they're also trying to diversify. They've launched the live entertainment
district.
And,
Yeah.
So
In
I
fact, some of the
understand,
money which has gone into those, the investments which have gone into those, have actually pulled down the aggregate profitability, despite the fact that on the quick commerce business, they've actually reduced losses at a faster pace than what was anticipated by the market.
So, earlier you mentioned star fund managers. And while I think some of that is very much still continuing, but there is a new star in the industry, and that's technology and AI. So, I want to understand, how is Invesco using technology, data science to build its portfolios?
No, I think with regard to technology, I think we are still in the very nascent phases as an industry, I would like to think. And, it is still a very people oriented activity. Especially active investing is a lot about investor behavior, psychology, and those kind of things. So whether they can be very easily modeled is remains to be seen. I'm not sure about that. But can we have a lot more of technology orientation in terms of, cutting down some of the uh, more mundane activities, or probably trying to, do quick balance sheet simulations, developing spreadsheets, modeling. I think that is a part where we can probably make use of a lot of technology. We do in some ways. There are certain tools which are available even today and have been around for a very long period of time. But I think AI tools are still, quite nascent as far as this industry is concerned, and it is still, something which is in its evolution. We will probably see more of that as we go along, but it will probably be difficult for it to, start replacing that very hardcore judgmental activity, uh, which is the heart and soul of investing at a certain level.
Absolutely. You have seen the markets from the pre liberalization days to today, where the environment is very, very different. You worked with some great investors yourself. In fact, I believe you started your career with Mr. Raamdeo Agrawal.
Yes.
I'd love to, get a snippet of what those days were like.
So, yeah, it's a very interesting question, and I was just starting off my career. He's been my mentor in a way, and I say that on many occasions. I don't know whether he agrees to it, but I definitely subscribe to that, and I cherish the time that we have spent together in my initial phases of my career, simply because I think while I was starting off as an analyst, I was a complete rookie, and he was kind enough to actually take me in as a junior analyst under his tutelage at that point in time. But the interesting part was that even he was a very young, budding investor at that point in time as well. I mean, well, he was in his 40s, I would guess. But yet, from an investment experience standpoint, we were all in our learning phases. He himself was in his earliest phase of learning, if I were to probably think about. Um, uh, and it coincided with the period, as you said, which was just post liberalization, and we'd been going through a tough time in the economy. This I'm talking about circa 94, 95. So maybe 2 or 3 years after liberalization happened. And I think India itself was awakening to investments, and even professional investments. I think we didn't really have as many research outfits at that point. Barely 5 or 6 research outfits which were conducting investment research of a certain professional order at that point in time. And Motilal Oswal and Mr. Agrawal was spearheading that. So it was nice to be part of that initial journey. He was also awakening to the fact that as to how businesses should be thought about. His whole journey with Warren Buffett had begun just around that same point in time. So it was very nice coincidence for me also to have been part of that journey. I remember in 97, 98 approximately is when he started on his wealth creation studies, which
Yes.
became very popular, which have been very popular ever since. Maybe they would have done a at least a 25 out of those since then. And I was the author of the first wealth creation report, which came
Oh.
about in 97
How wonderful.
along with him. So that was a huge learning experience in terms of how to think about the aggregates of the market, and market performances, and so on, and what wins and what does not win, and so on and so forth. So that was a huge, great learning experience. I think as a team we also hit upon some very interesting investment ideas at that point in time, which went on to generate significant amount of wealth for investors over a 10, 12, 20-year time frame. I'm talking about companies like Hero Honda, Hero Motors today, HDFC Bank. I remember Cipla and a few other companies which were, those strong multi-year compounders, huge free cash flow businesses, great managements, and that combination, and the kind of investment returns which followed as a result of it, as a result of which, brought this whole uh, awakening to the fact that what a good business can do and what should it have in terms of characteristics to be able to generate that kind of wealth. So I think having been part of that exercise, those were those golden years, I would like to think. And a lot has changed, of course, after that in the last 25 years in terms of the investing world as well as in terms of investment experiences. But some of those things, those learnings at that point in time, they're still very grounded. I'm sure even for Mr. Agrawal, he must be valuing those days. We used to come up to a lot of reading and
Yeah.
shared reading at that point in time, and this whole thing about understanding Warren Buffett, and he became the icon, and he became everything for him and for many of us who actually started to imbibe his principles. So it was great at that point in time, having been part of the same learning journey.
On that wonderful note, I think we'll move on to the rapid fire, so to say.
Sure.
And we know that you've seen several market cycles, and you think deeply about the market moves. But here, only top of the mind, instinctive answers. Okay,
Sure.
all
Let me
right.
try.
So, what current market trend do you think is overhyped or misunderstood?
I think what is probably overhyped and at the same time misunderstood is AI.
That might be controversial.
So it is at a stage where it has both the elements. In the very short run, it looks like it is overhyped, but I'm sure that there will be one lasting technology once again, which will probably make a lot of difference. Started to make a lot of difference already to our lives, and it is significantly different, perhaps, from even some of the other, similar technology waves. You think about internet, mobile, etc. Uh, uh, did have implications on our life and have done a lot of wonderful things. But AI is the next, and I think it will have a far higher longevity than perhaps some of the other technology changes. And more particularly, I think there's a closest which comes to, displacing humans at some level, as we know, if not at all levels. And that makes it frightening, exciting.
But that's a
to
longer
that extent.
debate to be had.
Yeah,
That's
it's a far longer debate to be
Yeah.
had. It can't be part of your rapid fire, but this is my 2 bits around it.
Okay, so moving on then, one overhyped investing metric.
Well, I wouldn't call it overhyped, but sometimes it's difficult to kind of rationalize everything under it. Is discounted cash flow. DCF becomes a little difficult at times. A lot of parameters which go into it. I wouldn't call it overhyped as such, but it is something which is not easy to comprehend and build your investment conclusions around.
That sounds like the answer to my next question, which is that it's an underrated investing metric.
I would say overrated because there's a lot of reliance on that, and
Okay.
many people swear by it as well. But I think it has a lot of dimensions to it which are probably difficult to capture, and uh, that perhaps leads to wrong decision making, I guess.
Okay, so what is the most underrated investing metric according to you?
I think at times PE works the best, and sometimes we underrate that, and believe that it is not the right metric, and but it does at one level works best under many circumstances and many kind of business models.
Can I tell you what Mr. Raamdeo Agrawal said?
P is being used almost like the benchmark for everything. So when you are looking at the P, particularly when you go to individual stock, then it can be very misleading. When you go to index level, then it's a very diversified, broad. It gives a really good sense of where the market is. Like if it is 22 times Nifty P, that gives some sense what it means for the market. But when you say 22 P multiple for a company, I don't know what you're talking about.
He said PE was the most overhyped investing metric. So I thought I should bring that
Okay,
in.
fine. So our views have changed over a period of time. That's nice.
So, what is the most important virtue or quality for a retail investor?
Time and patience.
Okay. What is the most important virtue or quality for a fund manager?
Well, I would say patience is once again it's important to fund managers as well. But I think it's about attitude. Can't get the exact word around it, but your psychological framework is very important. I mean, you have to be able to exactly, you have to be relatively more balanced. I think it comes with experience probably, but it's about your overall psychological makeup, which probably differentiates one fund manager from another.
Okay. Books that you recommend that you feel have the power of influencing someone's investing philosophy?
A number of them, but some of them which probably come to mind in the current context of the world is, recently been reading uh, Yuval Harari on Nexus. That's something which is very relevant, especially in this whole debate around AI and how humans, despite all their power to conjure up a lot of information and build networks, can still go wrong and develop networks which, beyond a particular point, can be harmful as well. So that's something which is very interesting, and basically, I think it'll um, to those who are skeptics of AI, probably it will appeal a lot because it tries to temper down your enthusiasm around AI as well. So I think that's one which I would probably like to talk or recommend. I think the other one, which from an investing standpoint, which I found quite interesting, is How Not to Invest by Barry Ritholtz. That's another one which basically talks about what not to do in investing, and even things like, bad advice, bad bad number crunching, bad uh, thought processes about markets. I think those which lead to catastrophic mistakes, accidents. Uh, that is also, I think, very important for investors or fund managers to realize. And I think that book talks a lot about that, what not to do. And that's something which I think maybe listeners would probably find interesting. I think one of my all time favorites has been this book called Seeking Wisdom by Peter Bevelin. And that basically goes to discuss as to what drives our behavior, what drives human behavior. And it starts from that as a fundamental um, part of the core of the book. And because it is about aspects which drive our behavior, it then tries to branch out into several aspects of, whether it is about biology, psychology, physiology, chemistry. So it's a very comprehensive read, and it carries a lot of information from Darwin to even Charlie Munger, for that matter, and encompasses their thoughts. So it's a book which I've read multiple times, and I still feel I'm starting
It's
afresh.
on my reading list now that I've heard about it from you.
All right.
So
okay.
thank you for sharing that. But if you weren't managing money, what would you be doing?
I most likely would have probably continued to be in the engineering field, in the tech field. Perhaps that's where my original domain was, and probably my interest levels too were over a period of time. Maybe I got corrupted with the financial markets, equity markets, and I changed track. But I think had I not done that, I was reasonably geared up to being a maybe decent engineer. Perhaps I would have been in some software company, I'm sure, writing code.
Sectors that you feel will be in focus in 2026?
So, since we are in the midst of it, I mean, we are getting pretty warmed up about the whole consumption uh, part of the economy, and that I think will be quite an important theme for 2026. Uh, like as I said, I mean, every theme has its timing which comes about, and then there is always a confluence of factors which leads to it. So I think that was brewing in our minds since the beginning of 25, but we were not finding all the levers coming through. Today, we feel that many more levers are in place, whether it is taxes or whether it is interest rates or whether it is government policy. I think policy is very important because in the last 2-3 years, government policy has worked in a particular manner post COVID, and now over the last 12 months or so, we see the policy configuration changing. Government's thrust is on trying to drive consumption simply because it is a very large part of the economy at this stage, and we are also in a phase where we are somewhat geopolitically and geo-economically isolated in a way, and therefore it is important that we are as Atmanirbhar as possible. So I think from that standpoint, it is important that consumption, which is the largest part of the economy, receives as much of attention, and I'm sure the government is therefore seized about that. So when policy coincides with some of the other economic factors, then I think the chances of that sector starting to show better growth characteristics starts to come about naturally.
Mm.
And if that were to happen, then I think the investor reward could be pretty decent over the next 2-3 years.
So, the most important piece of advice you'd like to give investors for 2026?
Well, 2026 and even beyond 2026, I think the timeless, principles of patience and continuity. I think you need to, take a more longer range view of things. Uh, you know, uh, I would like to say that probably it is important that you diversify to the extent possible. Uh, and in the evolving backdrop of the world and its complexities, like as I said, I think uh, having asset class diversity is going to be important. So think about that well, and I think these are some of the things which I think should be good, not just for 2026 but even beyond.
What's a personal goal that you're hoping to achieve in 2026?
Haven't really thought of it. uh, well, I'd probably like to complete many more books than I've probably been able to do in the last 2 years. So I just hope that I can find more time for myself to. I think if possible, I would love to, learn more of some of the AI tools myself, because that's going to be relevant for all of us. And uh, yeah, I think those are some of the things.
That
Couple of
pretty
things which
much
are
covers
probably-
it then.
Yeah, I don't know whether I'll have time for more than that.
So let's move on from metals to mutual funds now, where the Indian retail investor really has been shining for quite a while now, and there's such a boom in the industry. And when we look at how influential AMCs have become in how people are investing, one has to ask, what is the differentiator that Invesco is offering? Because, like I said, it is a very crowded market now.
Well, all along, I mean, for us, our biggest trump card has been our investment processes and our, investment philosophies, which have been very, very grounded and have been very consistent throughout our lifetime as an organization. So ever since we started in somewhere around 2007 up until now, for almost 18-19 years, we've actually kept to the same investment process and investment format and approach, which basically I think differentiates us in a big way, because I still feel that as an industry we still have very limited number of players who actually are committed to a process oriented approach. It's nothing wrong with the industry as such. It's a part of the evolution of the industry. We started off, we look at one level. If you look at the Indian mutual fund industry, we are maybe about 30 years or so thereabout. So we are not too young, we're not too old, and we obviously we are going through our own evolution. I think therefore the first maybe 20-25 odd years did belong to staff fund managers, things like individual personalities, and several of those personalities over the last some time I've been with many of them and grown up along seeing them, observing them. They have done exceedingly well and delivered some fantastic investor returns over a period of time. But now I think there is a phase where things are getting more and more institutionalized. We are growing larger. There is a certain amount of institutionalized expectation out of mutual fund houses and money managers. So I think the time has come when we have to be more professional, more process oriented as such. And I think to that extent, it is nice that at Invesco we've imbibed that philosophy of approaching investments through a process oriented framework right since the beginning. That ensures, to some level, the fact that we don't need to necessarily be dependent on any particular personality. Our investment processes decide as to how we are going to manage money over a period of time, and that probably ensures continuity and consistency of outcomes. So I think that is what we believe has been our biggest differentiator, and this is something that we have very constantly highlighted, very consciously highlighted on several formats, several locations, right since the time we have been around. In fact, we are probably one of the very few AMCs who publishes actually an investment process document every quarter to exactly say as to how we would want to do things. And that's easy for investors. From an investor's point of view, they are not necessarily buying a Taher or a Amit or a few others who are there in our organization, or some of the other members of my team, they are buying basically the promise and the process and the promise that Invesco will continue with that same process, irrespective of whether individually or B or C is with the firm.
Since you're taking a contrarian bet, you're moving against market trends, is there a time frame that you keep in mind that you're hoping within that time frame the allocation, this bet is going to pay off? Because otherwise that capital may be better deployed somewhere else. So is that something that you keep in mind?
So in our minds, actually, we do work with a 3-year kind of a horizon.
Okay.
Because we feel that businesses which are probably not doing well now, you need to give them adequate amount of time for them to be able to come back. When you're going through headwinds, when you're going through challenges in your business or the industry structure, or sometimes probably on account of your own failing, things do not change overnight. It takes time for businesses to be able to make a comeback, for margins to come back, for growth to come back, and so on. So I think 3 years is something that we found over a history of managing this fund for the last many years, that 3 years is a reasonably decent time for us to take a bet on a certain business which is not doing well and for its ability to come back. So I think that is how, and that's exactly what goes into our communication with investors as well. That is why when we actually try to sell our Contra fund to investors, or investors look at our Contra fund, we make it very clear that this is a fund that they should look at from a 3-year perspective, minimum 3-year perspective. Unlike our growth strategies, where you might probably want to come into a mid cap fund or our large cap fund or a large and mid cap fund for even a horizon less than 3 years, because they are about growth stories, they're about growth companies where growth is already visible. So even if you buy it for the next 2 years, next 1 year, you may still be able to get that growth. But value is about time, and it value crystallizes over a period of time. So you need to give that sufficient time. That is why when we even measure our portfolio companies, which we buy from a turnaround standpoint or from a value standpoint, we do keep a 3-year expectation that, okay, over a 3-year period, they should be able to deliver on some of the expectations that we have. When we go back to our process and our investment framework, we assign a certain categorization to every business or every company, which gives us a very clear picture in terms of what our expectations out of that company is. If it is a turnaround, we then start monitoring for turnaround kind of characteristics over the next quarter and the next 2 quarters and the next 4 quarters. So in a turnaround, we would like growth to come back, growth to accelerate. We would like operating earnings to start improving. We would like to see improvement in profit margins, or reversal in profit margins from negative to positive. So if those deltas keep coming about as we expect, we would still continue to be with that stock, because we know that the business is moving in the right direction the way we expect it to. We are reasonably patient. We know that some of these things don't happen very soon. Like as I said, we need to give them a good time frame. But if we probably have an extended period where, let's say, for more than 2 years or for a string of quarters, what we had expected out of the company does not materialize, then I think we will change our mind, and we will change our opinion on the firm, and we'll take appropriate portfolio action in order to ensure that we reduce the risk or substitute it with something else in the portfolio. But that is how we approach things. So we have to give it adequate time. But at the same time, we are guided by a process. We are very focused on the outcomes from that particular business. And if we do not get those in a reasonable period of time, that is when we would want to move on.
I'm sure you're seeing a surge in new investors. The demat account numbers tell us that. Now, given market volatility, when you are talking to new investors, how do you convince them to stay committed, especially when they're looking at downturns in the market? And what are some of the factors that make you readjust the SIP inflow guidance?
So again, we obviously have to understand the first principle is essentially that investing is about the long term, right? And we can't take 1 year, 2 year kind of calls or go by those horizons, because those we can. Investments and markets are influenced by several factors which are beyond our control, and therefore, in the shorter term, obviously, we cannot have as much of predictability. But I think what is the beauty of the market also is that investment returns are very strongly linked to underlying business fundamentals, especially on a 3-year, 4-year, 5-year, 10-year time frame. And that typically does a catch up, no matter how much ever the noise levels might be with regard to several other factors, whether it is about geopolitics, economics, and several other things which are going around the world. But eventually, investment returns, the one thing which it always tries to align itself to is underlying earnings growth and underlying corporate performance.
Yeah.
And I think that part of it is relatively more predictable on a 3-year, 5-year, 10-year format, okay, which is not as much predictable on a 1-year, 2-year format. So if you were to probably keep to that, conviction of some of the businesses that you like and the way they are going to unfold, and are part of your portfolio, then your ability to predict returns is a lot more higher compared to otherwise. And that is where we derive our conviction. So when we have investors who come in every now and then, and we or coming through the SIP route, the lump sum route, or whatever, we basically impress upon them the fact that, look, we have to take a long-term view of things. We have been fairly consistent. I mean, if you look at our investment performance outcomes, you would see that we generally tend to outperform the market and deliver positive returns more than 90% of the time on 5-year, 10-year, 5-year, 7-year, 10-year scale. But on a 1-year, 2-year, 3-year scale, it could probably drop down to maybe 70, 80 odd percent. But it goes well past 90% when you were to probably take longer horizons. So that is the promise which we have seen, but provided we follow a certain process. Okay, if you're going to be indisciplined about investing, then you are probably going to lose out even on a 3-year, 5-year, 7-year, 10-year time scale. But if you are reasonably proficient and you are disciplined about doing things in a certain process-oriented manner, then I think returns are far more predictable, outcomes are far more predictable, and that is what we can make as a promise to our investors. So that's why we always come back to the process saying that, look, irrespective of whenever you come to invest with us, or at whatever frequency, the guarantee is that we'll give you that same process. And that process over the last 15 years, 20 years, and several product lines has been tried and tested, and it has delivered. It's like a machine. You put the right input, you'll get the right output. Okay. And so long as we keep doing that well, I think consistency of returns is bad. The number could fluctuate. Okay, at times it could be 10%, at times it could be 20%, but I think the ability for us to be able to beat the market is a lot higher if we were to follow this disciplined investment process. Yeah.
Well, thank you so much for joining us on Groww. It's been a pleasure speaking with you.
Thank you. Same here. Thanks for having me once again.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.